Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. I'm Daniel Dusina, Chief Investment Officer.
I'm Dan Cedar, Managing Partner.
And I'm Vince Perrick, Investment Analyst.
Thanks again for joining us. Today we have a few different topics we'd like to talk through. We want to start with a discussion on interest rates and the Federal Reserve. Feels very timely. We want to discuss briefly some elements in the information technology space that relate to big corporate moves and some potential antitrust or regulatory concerns. And then we'll close out today's conversation with some market sentiment, some possible risks, also some potential for opportunity. And then before we let you go, we'll give a brief recap and some things that we have our eye on over the next couple of weeks. So anything else I missed, guys, before I jump into things?
Sounds good. Let's do it.
Great. So the reason I say our first topic with regards to the Federal Reserve and interest rates is very timely is because the Federal Reserve is slated to meet this week. One of the most dominant themes we've seen over the past 2 weeks have been interest rate expectations, especially around the Fed. And here's what investors are parsing through. The market widely expects a 25 basis point rate cut from the Federal Reserve in its September meeting. We've seen economic data that has started to show some signs of a weakening labor market. That certainly aligns with interest rate cut hopes, but we have inflation that remains above target. So we have some folks that are more or less kept on edge about how many rate cuts the Federal Reserve really can enact. There's also some talk around updated Federal Reserve projections. There's something called the dot plot that essentially puts out what Federal Reserve voting members envision for the trajectory of interest rates. There's a lot of optimism and I guess just general consideration of signaling of further rate cuts through the rest of 2025. That said, we have a lot of chatter around warnings of sell the news type reaction, meaning you could get some semblance of market volatility even if you get an interest rate cut. So,
Daniel, how about a 50 basis point cut? Would there be a risk to the upside that there's a melt up in stocks?
I think it's possible, but in my opinion, not likely, just because of what I said.
The rate cut, the 50 basis point rate cut, or a melt up?
I think the 50 basis point rate cut is unlikely in my view. Okay. If you did get a 50 basis point rate cut, I actually don't know that it would be overwhelmingly positive from a reaction standpoint, just because if you do get a 50 basis point rate cut, that means that the Federal Reserve voting members are obviously more concerned than just a standard pullback interest rates 25 basis points. I think they won't go 50 just because of the fact that inflation has been a little choppier. Certainly a lot of what we've seen in the labor market has been somewhat concerning. Less jobs being added, moderate uptick in unemployment rate. That said, if you look at the balance of that dual mandate that we've talked about so many times on this show between the labor market and inflation, I think that the Federal Reserve would not be willing to overextend themselves and cut 50 basis points.
Got it. At this point, though, we're looking at the market has priced in a 100% likelihood that there's a 25 basis point cut here.
Correct, more or less. And the other thing, Vince, I thought you brought up a good point with regards to what the rest of the year from an interest rate perspective could potentially look like.
Yeah, absolutely. I mean, as you mentioned, at this meeting, we'll be getting updated projections or updated dot plot. So in that, we see the expectation of Fed members for how many cuts there are left by the end of the year. At this point, we're getting pretty close to the end of the year. We have 3 meetings left, including this week's for the Fed. And on both of their previous projections, they were pricing in essentially 2 more cuts from where we're at now by the end of the year. So with updated projections, we should be able to get a better idea of the timing of those cuts. As of right now, we have 3 meetings, 2 cuts priced in. We could see a change in the projections, possibly 3 cuts. At that point, we could expect 1 cut per meeting. A little bit more of a definitive number of cuts versus meetings to kind of, work out your landscape of what you expect.
Yeah, I think that's spot on, and I think that's going to be important to watch. The other, I would say, tangentially related to this, before we close out our discussion on this topic, would be we haven't really talked about the allocation we see to money market funds today, how big it is, and why it's important. We have over $7 trillion allocated to money market funds here in the U.S. There has been discussions both from us at Blue Chip and from others in the media around when might you see that money market fund allotment start to come down, and what would that mean for other parts of financial markets? Now, I think that until you get to a level where money market funds are bearing less than 4% interest on an annual basis, I don't think that individuals in particular will be overly willing or rushing into parting with that healthy, relatively risk-free coupon. But if you do get into an environment like one that Vince kind of outlined, where you do get 3 more 25 basis point rate cuts between now and the end of the year, you very well may have investors start to rethink their allocation to an asset class that's no longer paying you a 4% plus yield. That could mean an allocation to the more traditional bond market, treasuries, corporate bonds, other items. It could mean upping their allocation to the equity market. The reason I bring this up is because $7 trillion is a lot, and I'm not going to say that all of it will be in motion, but even if you get 10% of that money in motion, it's a very big number that could ultimately serve as a floor underneath traditional equity and fixed income markets. Something to watch, to be sure.
Mm-hmm.
So switching gears a little bit, moving over to the information technology space, we had a pretty big news story around Nvidia. We had Nvidia that's come under fire. China's regulators have launched investigations over antitrust concerns related to its acquisition of a firm called Mellanox. Vince, you had some color commentary there in terms of speculation as to why this is happening, when it's happening, et cetera.
Absolutely, yeah. So it's interesting timing here. This week we have trade talks between Scott Bessent and China's equivalent negotiator, as well as a discussion between President Trump and President Xi Jinping at the end of the week. So a lot of investors are viewing this as part of a negotiation tactic to kind of increase the pressure from China on the U.S., possibly, factor that into their negotiations for, a little give and a little take here. This might be one of those things that they're planning on including in those talks.
Yeah, interesting. Another big thing to watch, I would say, for sure. Even though not technically in information technology, I would call it as a part of broader big tech, you had Elon Musk buy roughly $1 billion worth of Tesla shares, which sent the stock higher. This kind of insider leadership move does tend to send a strong signal to markets. So overall, we have the tech sector that continues to carry a very big weight. I think about 33% of the S&P 500's sector allocation right now. But it's under regulatory scrutiny. And some of these corporate actions are contributing to volatility and potentially opportunity. It will very much remain a sector that is in the driver's seat, both to the upside and downside. And I think one vote of confidence that I would provide is even though tech is a very large portion of the S&P 500 index, you've also seen earnings growth be very strong and leading the charge for the broader market.
What I would say about Elon Musk, okay, $1 billion is a ton of cake. That's not insignificant. But what's $1 billion relative to his net worth? What's he worth? I mean, I'm guessing here, $200 billion, $300 billion. And so for $1 billion to flow into a company, yes, on an absolute basis, that's a huge number. On a relative basis, I mean, it's a rounding error on his balance sheet. So I think it's more of a headline than anything else. Sure, yeah, is it going to send some confidence to the markets? Yes. But at the end of the day, I think that's walking around change for Elon Musk. And $1 billion just on a relative basis isn't that much.
Yep. I think it's a very important point because just like everything, at least in our realm of finance, it's all relative. You need to view things appropriately, relatively speaking. All right, next topic. We're going to dive into a little bit around market sentiment, some potential risks. So I also think this is going to be important in terms of investor expectations and what to watch going forward. So we have increased expectation for rate cuts. That also introduces increased risk of disappointment. We touched on this a little bit, but if the Fed does cut less than hoped or signals less forward easing, you could see some market pullback. I think that's very different than getting a 50 basis point rate cut right away versus a 25 basis point rate cut. I think this is more aimed at talking about the forward trajectory that Vince was outlining. So if all of a sudden you do not have Fed voting members that are buying into this 3 successive 25 basis point rate cuts. I do think that is more or less broadly expected by the market at this point. So you could see the S&P 500 suffer some of the momentum being lost that we've seen in recent months. Now, you also have inflation that's remained a concern globally, as does the persistence of some supply chain problems with geopolitical risks. I guess my point is, you've got a market in the U.S. that's at all-time highs. There are still risks looming on the horizon. That said, sentiment is a very valuable tool that I think we need to consider at this juncture. What are you seeing there?
And sentiment right now, well, I guess sentiment at any point is valuable at extremes. So if sentiment would suggest that investors are greedy, that's when Warren Buffett says, be greedy, be fearful when others are greedy. And if sentiment is fearful, well, be greedy when others are fearful. Right now, we're dead smack in the middle from an investor sentiment perspective. So I would look to see sentiment more at a greedy level if it was indicative of a top in the markets. I just don't think sentiment stays neutral if you're at all-time highs in stocks.
Right, and that's where we're at right now. You look at the CNN Fear and Greed Index, we're kind of right in the middle of the dial telling us it's neutral, and I'm not going to say pay no attention to it until it's at extremes, but realistically, historical data would tell you that it doesn't become overly valuable until you hit those extremes.
Yeah.
Only other items I would mention around risks in the market, you've had bond yields that have been very volatile. Borrowing costs outside of the U.S. are rising, and even longer term, you're seeing persistently high yields in treasuries. Then you also have some element of seasonality. Seasonality, when you look at September, historically speaking, it's one of the weaker months for equities. So you combine that with some of the macro-oriented uncertainty, the geopolitical risks around Trump and some other items. Yeah, I think there's just potential for choppiness in the market as we look between now and the end of the year.
Yeah, and seasonality matters. Even though September is historically one of the weaker months, we've had a great start to September. And so if that ends up persisting throughout the rest of the month, that is the signal. In a month when you're supposed to have weakness, you actually have strength. What is that telling you about the underlying market or the economy?
Right. All right. Well, let's wrap up the show here. I want to call out a few different things with regards to what we think are very important to watch, and then I'll provide a brief recap. So as we look forward, of course, the Federal Reserve meeting this week, September 16th to September 17th, very much top of mind for everyone related to the market. I think economic data overall, things like unemployment, retail sales, inflation, all of these things are top of mind for investors, but also for the Federal Reserve. So I think I would lump those two together. I think some of the stuff we've seen with regards to China and regulatory moves, any further antitrust investigations that are kind of related to strong arming or bargaining chips, if you will, with regards to broader foreign policy. And then finally, I think that even though we're not in the heart of earnings season right now, I would say the earnings that were reported in aggregate in the U.S. for the second quarter were pretty darn good. That's going to flare up again a month from now. I think very important to watch, especially in areas like tech and financials, and how companies are talking about the future are going to matter very much. Vince, there was one other additional point that you wanted to call out.
Yeah, absolutely. So this one is a bit further out, but we'll definitely be keeping an eye on any developments, and it relates to President Trump's tariffs. So lower courts have already ruled part of them unconstitutional, and the Supreme Court is expected to take this up over the next few months. So this isn't expected to really have any concrete news until the end of the year, early next year, but it could certainly shake things up quite a bit. So we'll be, maintaining an eye on that topic, and we can expect some more headlines coming end of year, early next year.
Great. Yeah, great call, Vince. So just to summarize, we talked about the Federal Reserve, interest rate trajectory. That will continue to be top of mind. We also talked about some developments in the information technology space, both with regards to Nvidia and Tesla. Then we closed out with some commentary on sentiment, possible risks with a market at all-time highs, and then giving you some of the items that we plan to watch closely on a go-forward basis. Anything else to add, folks?
That's it.
Yeah, that's it for me.
Well, as always, thank you all for joining in to another episode of Blue Chip Now. We look forward to speaking with you again next time.